So the basis we select, we have 5 major criteria that we look at to try and to pick the best ETFs that we use in our portfolios. And this chart effectively explains the different 5. Now, size is important because you want to make sure that the fund is sufficiently large that the manager or the issuer is making enough money to keep the fund going. There is an issue if a fund is too small, and it could be performing really well, but if it's too small and the costs of running the fund are more than what the manager's making, they will close. And BetaShares is a very good example of that. They close 10 to 15 funds every year just because they haven't reached critical mass or they've not been as popular as they thought. It's not a problem. You don't typically lose money, but you do have this problem that you're giving your money back, perhaps when you don't want to get it back. You then have to find something else to invest in, and it can crystallize a capital gain because they're cashing you out when the fund's gone up, say 10%. You get your money back when it's 10% higher when you didn't particularly want to. So we tend to go with large, big funds because we know that they're going to be around for quite a long time. Liquidity is the other one. It's just, how easy is it to buy and sell? The beauty of index funds is typically they're as big as the market underneath them. So if you look at the ASX 200, it's almost $1 trillion market. It trades, tens of billions of dollars every day. If you wanted to buy $1 billion of an index fund, you could do that today without probably moving the market very much. But if you're buying $1 million, and we can buy and sell 10 or $20 million on a day, we know that we can buy and sell it without moving it particularly. It's liquid. Obviously, as you go down the market sizes, if you go to the small cap market, it becomes slightly harder. There's a constraint if you buy into assets that are sort of illiquid. Let's take Bitcoin as an example. Bitcoin is a difficult one because nobody knows how much trades every day. It's not a very visible market. So you never know if you're buying $1 million or selling $1 million, does it actually move the market? The third one's tracking error. So this is probably a more important one. If you're trying to get the returns of an index, you want to make sure that the ETF actually follows the index, and it's day to day there'll be small movements on the bid and offer as the markets move, but over the long term you want to make sure if the index is up 10%, your ETF is up almost 10%, less whatever fees it's charging over the same period. So that's an important one, and we look for tracking over 1, 3, 5, 10 years just to make sure that it does track on a regular basis. We're not too worried about day-to-day tracking. It's just making sure over the longer period it tracks well. The fourth one, I think we've discussed, the fee structure. That you get the index return less whatever fees you get charged. So the lower you can make those fees, the lower the transaction costs, the lower the management costs, the better, the closer you get to that index return, which is what you're trying to get. So that's probably one of the more important ones. And then the last one, which is the most important one that we look at, is the bid-offer spread. Now, just to explain to the watchers just what that means. If you buy BHP, so BHP will be, say, $40.10 today, will be the bid price, but the offer price could be $40.15. So you've got that 5-cent bid-offer spread. Now, on $40, 5 cents is 0.1%. So it's not much, right? But some ETFs have spreads that are 1 to 1.5%. So you want to make sure those spreads are reasonably narrow as to when you can buy and sell without having to incur too many costs. And that's the one a lot of people forget. They'll buy something and thinking, oh, well, I've got this. Obviously, the longer you hold it, the less important that becomes. But you want to make sure if you come to sell it, you're not paying brokerage plus a big spread. The best example are the cash ETFs, like the AAA that BetaShares has issued, or the BILL, which iShares has issued. They typically have a spread of 0.01%. So you can buy and sell those relatively easily without incurring too many costs. So those are the 5 factors. we weight them differently, but typically we go for the fee structures and tracking error and the bid offer spread. That's the main ones, and it's tracking over a longer period. So I think, Alan, if we want to move on to the next one, unless there was a question that was coming up. There's a question here from George Moskos, which I can answer. All ETFs, well, just to answer George's question, just how ETFs, and this is more index ETFs than active ETFs, there's usually a market maker, and it's usually a big bank. For our ETFs, our active ETFs, we use Citibank. So there's Citibank, there's Deutsche Bank. So all the ETFs have market makers, and the market makers will make a bid and offer price in the screen all day. Now, the size depends on which market maker you're using and what sort of index that they're looking at. We have 100,000 units on the bid and offer all day for our funds. If you look at those cash ETFs like AAA and BILL, they, I think, have 500,000 units, approximately $4 or $5 million on the bid and the offer all day, every day. So the market makers are there, but again, the bid offer spread is usually determined by the liquidity of the underlying assets. So you can have bid offer spreads that are wide. We've seen funds, which have a bid offer spread that's, 1% or almost 1.5%. Those are the ones you've got to be careful because, it's an extra cost to buying and selling. The market makers will make the market as close as they can, but there's always a spread. And it really depends on the assets and what sort of fund it is.